Welcome to the Optimize Monthly Snapshot. I'm Matthew McGraw, CEO and President with Optimize, and for this snapshot, we'll keep you updated on the moves in the market over the past month, provide some highlights from our portfolios, and touch on some of the opportunities we're seeing on the horizon. As we continue into the fourth quarter, several key developments have driven market optimism. Canada's inflation sits at its lowest level in 3 years. The Bank of Canada has made 3 consecutive 25 basis point rate cuts, plus its most recent being 50, which should help boost the economy and asset prices significantly. In the US, large banks continue to outperform, and a stronger than expected labor market reinforces economic resilience. With robust returns from the financial sector, we remain extremely confident about the positive momentum in the markets heading into this year's final stretch. I'll start off by talking about one of the most anticipated announcements in October, the Canadian inflation rate, which fell to as low as 1.6% in September, its lowest level since February of 2021, and down from 2% in August. Gasoline prices dropped 10.7%, and transportation costs dropped as well. With shelter inflation easing and rent growth slowing to as little as 8.2%, inflation remains well below the Bank of Canada's 2% target. Now turning to the earnings of US major banks, JPMorgan, Goldman Sachs, and Bank of America were among those that beat earnings expectations, supported by the US Federal Reserve's recent 50 basis point rate cut. This boost to the financial sector encourages more lending activity, and with low delinquency rates, we expect further profitability. This has also resulted in the financial sector increasing by more than 25% year to date, which we expect to maintain its strength as interest rates continue to decline. Our final highlight is the continued strength of the US labor market, with 254,000 jobs added in September, far exceeding forecasts. This marks the strongest growth in over 6 months. Wages also increased by 0.4%, which supports the consumer strength and overall economic growth. Zooming in now to our position spotlight. This month we're looking at JPMorgan Chase, the largest US bank by assets and a real heavyweight in the capital markets. The company's stock price has significantly outperformed over the past year, up 60% relative to the S&P's 39% gain, and a lot of that has to do with the financial results that it has delivered. Its earnings per share of $4.37 and a 6% revenue growth to as much as over $43 billion in just the most recent quarter. The bank maintains its fortress balance sheet, holding as much as $1.5 trillion in cash and marketable securities, while returning value to shareholders through as much as a 2.4% dividend and a $30 billion share buyback. One standout highlight is the significant growth in net interest income, up 3% in the third quarter of this year to $23.5 billion, driven largely by a decline in interest rates. The bank also benefits from strong retail banking operations, leading the US in retail deposits for the 4th consecutive year. Overall, JPMorgan's solid financial health and market leadership positions the bank extremely well for continued growth, particularly as the financial sector benefits from the declining interest rate environment and the very strong economy we now find ourselves in. Turning to the opportunities ahead, with the US presidential election just weeks away, it's time to shift our focus back to the fundamentals. While political headlines and polling data may influence short-term sentiment, history shows us that elections in fact have very little impact on long-term investment outcomes. In previous election cycles, markets have tried to anticipate which candidate might benefit the economy, but time and time again, it's been shown that markets are certainly resilient in the face of political uncertainty. Looking at past data, the S&P has typically performed well in the year following a US election, regardless of its outcome. On average, the index has been nearly 10% higher, no matter which political party takes office. This emphasizes the importance of staying focused on long-term strategies rather than reacting to short-term political fluctuations. And so our approach remains rooted in building portfolios around large, well-capitalized companies supplemented by pension-style assets. As a result, this strategy has consistently delivered strong returns for our clients, and we certainly expect that to continue, regardless of the election outcome. Well, that's all for this monthly's market snapshot. It was certainly an exciting month with encouraging market trends and momentum. Thanks for tuning in, and we certainly look forward to seeing you next time.